I'm Yahoo Finance executive editor Brian Sozzi, fresh off the red eye from San Francisco. And you're taking a look at a live shot of the opening bells on Wall Street on this Thursday morning. Susan G. Komen ringing the bell at the New York Stock Exchange. O-Book Holdings getting things popping over there at the NASDAQ. But enough about my lack of sleep. We're fired up today like always. Markets are in a marking time mindset as investors wait for more damaging China trade headlines. They've been all over the map this week. Those trade headlines overlooked in the search for bad news is, well, the good news, as is often the case. Bank earnings this week have crushed. Shout out Morgan Stanley. Wow, hell of a quarter for them. And Taiwan Semiconductor results out today were simply impressive. So was this company's guidance. If you were looking for an AI peak, you didn't get it in Taiwan Semiconductor's earnings or their guidance commentary. Big quarter out of them. All right, let's get a quick check of the markets as we kick off trading and send it down to our own Allie now live at the NASDAQ.
Hi, Brian. Welcome back, by the way. But we are seeing all major indexes opening up in the green here. We're seeing gains being led by the NASDAQ composite up around 0.7%. Dow adding 120 points at the open and the S&P up roughly 0.3%. And this comes after those TSMC results, which you mentioned. That company reporting record third quarter profits and raising its outlook for the second time this year. And it's not just boosting the broader markets. We're also seeing gains across the larger chip and semiconductor space. I'm looking at NVIDIA up 1%, Broadcom up nearly 2%, Micron 3.5%, ASML, same story there. So just a lot of optimism over this AI trade. We've seen some potential frothiness. We've heard some warnings that we could be in an AI bubble, but at least for now, that's not a concern on Wall Street. I also want to take a look at the bond market because we did see the bond market move a bit on the heels of Fed Governor Chris Waller's comments. I'm looking at the 10-year yield trading pretty much flat, down roughly 1 basis points to just around 4%. 30-year yield is trading at 4.6%. And this comes as Fed Governor Waller said he supports another 25 basis point rate cut at the end of the month, but he did urge caution after that, signaling maybe a potential pause in December until there's more clarity on the labor market. He did point to conflicting data, saying that there's signs of a weaker job market versus still strong economic growth. And he said the Fed needs to be careful to avoid another costly policy mistake. And then, of course, we are over 2 weeks into the government shutdown. That has led to a lack of clarity when it comes to a lot of this government data. We will be receiving that inflation report next Friday. So that will give us a bit more clarity when it comes to how tariffs are working their way through the economy and what that ultimately means for consumer prices as well, Brian.
Allie, one, it's good to be home. Thanks for holding it down an opening bid. And then number two, it feels like the government, this is the quietest shutdown ever seen. It's just like in the back there happening.
Yeah, markets clearly aren't too worried about it. We are still trading at those record highs.
Indeed we are. All right, thanks, Allie. Appreciate it. All right, here's what I'm tracking out of the gate this morning, and it's not the government shutdown. A market with trade back on its mind. Investors continue to take their cue from President Trump and Treasury Secretary Bessent on all things China tariffs. We'll look at the playbook for successfully navigating these more volatile waters. The economy as seen through the eyes of Starbucks. Not all consumers are doing well, as we have seen in various economic data points. Just this week alone, GoFundMe CEO Tim Cadigan told me on Opening Bid Unfiltered, people are raising money to buy food and other daily essentials. That's really not good. I sat down with Starbucks CEO Brian Niccol at Dreamforce in San Francisco. I asked him how he plans to respond to consumer weakness, if at all.
You know, that's not who we are. What our business is craft, quality, experience. And, we should give you a setting where you feel like it's elevated. And, I love the line, affordable luxury or accessible luxury. Everybody deserves a moment like that. And we're going to be the brand that provides that experience in that moment.
So Starbucks looking like a Coach handbag, accessible luxury. Speaking of Salesforce's Dreamforce, we'll dive into the AI trade as software stocks remain under pressure due to fears AI will absolutely eviscerate the entire space. DocuSign CEO Alan Thiegason will also stop by to weigh in later on in the show. Here on the Opening Bid Roundtable, we got Cameron Dawson, NewEdge Wealth Chief Investment Officer, and Yahoo Finance senior reporters Ali Canal and Brooke DePalma. Good to see you all, friends, here on this Thursday morning. Cameron, let me start with you. Some concern about the state of the economy, especially in light of all this new concern or commentary around tariffs and China trade. I mean, what's your view on the economy here at this point in the month?
Yeah, we're not calling for the US economy to fall off a cliff, but there are clearly signs that it is slowing down, at least from the labor market standpoint, where you have seen hiring slow so much. It's not necessarily resulting in a big uptick in the unemployment rate because labor demand and supply are both falling at the same time. The challenge you have right now is that there seems to be somewhat of a decoupling in the US economy, where you're still seeing strong growth. Atlanta Fed GDP now is looking at 3.8% right now. But you also have really strong capex plans, but that's really diverging from what you're seeing from employment plans. So it appears that the US economy is being held up by things like AI capex, things like that high income consumer still being able to spend and pull everything higher. But you have the lower income consumer who's really struggling. The challenge is it's just not showing up in the aggregate data, which just puts the Fed in a very interesting position as they look to change policy over the course of the next few months.
And it's hard to even tell, Cameron, because we're really not getting any government data. I mean, it's not out there. The government's still shut down. But Cameron, once we do start getting this data, and yes, the government will be open, should investors root for weak data under these, I guess, that would mean more rate cuts from the Fed? I mean, is that what we want to see once that data starts flowing?
No, we don't think so. We think at the end of the day, risk assets like good data, risk assets like growth. So there can be short periods of time where weaker data can allow markets to price in more Fed cuts, which of course they do like. But at the end of the day, risk assets need earnings estimates to go up. They need GDP estimates to go up. So if there really was an environment where we're seeing much weaker growth, yes, the Fed would likely be cutting in that scenario, but we'd also be cutting earnings estimates. We'd also be cutting GDP estimates, and with an equity market and a credit market that are trading at near record high valuations, that wouldn't be something that we think that it would tolerate very well.
Brooke, you cover Starbucks. We're always talking to Brian Niccol on earnings days here at Yahoo Finance. Your take on his commentary on them not, or Starbucks as the accessible luxury. That's a new term for me, a new hot take.
Accessible luxury, it's quiet luxury, is that affordable luxury? That's what all the consumer branded companies are really leaning into right now, is they, can't really fight the chance that they have to raise prices or they have to keep higher prices because of the multiple different inflation factors that are playing in. And so they're all playing into this idea of value. And that's really affordable luxury, another way of saying it. But despite all these turnaround efforts that Brian Niccol is, leading the helm of, analysts on the street are still not convinced yet this will really turn around the sales slump, especially here in the U.S. that we've been seeing. Last quarter, they posted their 6th straight sales decline here in the U.S. And now this upcoming quarter, Wall Street's expecting about a 0.3% decline in same-store sales growth overall. And so it's really this leaning into this idea of getting those consumers back in the store and making that price point worth it for consumers to spend and perhaps hang out in their stores. Also, Brian, as you mentioned in your interview, just the idea of that 4-minute turnaround between order and pickup, that plays into this affordable luxury as well, being able to get something fast while also making sure the price is worth it.
Ali, I told Brian this. I like their new protein cold brews. I drank it. I spent my $10 on it over at JFK airport here in New York City. I felt stronger. Whether it's, I don't know what powder they're using, I just felt my better self. But you know what? A lot of consumers can't afford Starbucks. And there was a good survey out of Stifel about a week ago saying consumers are pulling back on these accessible luxuries, notably at restaurants. Medical bills are higher. Car payments are higher. So, I mean, I get the optimism in the economy, but there's a lot of consumers still not doing well. And I would argue doing worse out there.
Yeah, and you really need to dig through the tea leaves of not just the top line data that we get, retail sales and other types of government data. You also have to read things like the Fed Beige Book, because the Beige Book told us a bit of a mixed story when it comes to the consumer. They were saying that higher income households are still splurging on luxury travel, those types of experiences, but lower and middle income families are still seeking discounts and cutting back where they can. The Fed also flagged growing concern over the labor market. Layoff mentions jumped to their highest level in a year, while wage pressures do remain modest. Now, Chair Powell, he's warned that a low hire, low fire environment could quickly turn to a worse situation if layoffs start to decline. So you are starting to see the Fed talk more about the weakening labor market, how that could translate to a weaker jobs market. We got recent survey data from JP Morgan, which continue to show this bifurcated U.S. consumer where there. The lower middle income consumer still trying to seek that value that Brooke was mentioning. Higher income really propping up the economy. But at what point does the rubber meet the road there and you start to see a break? You start to see some deterioration. That's something the Fed is watching very, very closely.
Cameron, maybe the economy doesn't matter. Maybe all we need is 5 more big OpenAI deals, because we have seen as these deals have come out, they have lifted the market in a considerable way.
Yeah, well, maybe the market doesn't care as much about the entirety of the economy. It just cares about the aggregate data, which, to the earlier point, it really obfuscates just how much weakness there is in the lower parts of the market. We'd say that that's actually mirrored very much in what we're seeing within the economy. So you often say that the market is not the economy, but the economy has started to look a lot more like the market. And given how concentrated it is and reliant it is on AI capex. So to your point, if you were to see AI capex slow, it wouldn't just hurt the overall earnings of the S&P 500. It wouldn't just hurt the sentiment and this sort of ebullience that we see around the AI trade for the S&P 500, but it would also hurt the economy, given how much AI capex has contributed to U.S. economic growth. So it seems like AI capex is kind of Atlas holding up the world, and everything is relying on this one big important factor.
I love that, Cameron. What's the play here for AI? I just got back from Dreamforce. There was optimism on the ground, but some concern that many people are not even using a lot of the technology that Salesforce is putting out there in terms of Agentforce. So there's that. But the software stocks have been hammered this year under this view that they're going to get hammered by new AI technology, especially ChatGPT. Are those plays where you go? Maybe they have low valuations, or do you keep riding like NVIDIA, AMD, those names that have been winning in this environment?
I think we have to make a delineation between the companies that benefit from the capex infrastructure build out of this technology cycle and those that will either benefit or be disrupted from the actual application of the technology itself. And that second part is still very much a remains to be seen. So all of the earnings upside that we have seen from this AI trade has come from the infrastructure portion of this cycle. And that's very similar to what we saw back during the 1990s, where the infrastructure build out of the internet ended up being very different than the actual application of the internet for who won and who lost. So I think that is something that we'll be contemplating more in 2026, 2027, potentially as the AI capex growth rate starts to slow.
Ali, you and I have talked a lot about this AI bubble, if we're in one, even what is it? And I was talking to people on the ground at Dreamforce. They appreciate the technology that Salesforce is coming out with, and a lot of its competitors are coming out with, but it's not being used yet. And if it is being used, it's not, in a lot of cases, people aren't paying for it. Isn't that the quintessential sign of a potential bubble here? Everybody's so excited about the future, they're forgetting about the near-term risks.
Right, and you can look at OpenAI as a prime example of this. This is a company that is not making money yet, just announced a slew of deals with very high-profile AI names like NVIDIA, AMD, Broadcom, in the trillions of dollars. So even on opening bid, we were speaking with a variety of strategists this week. Some say with absolute certainty we are in an AI bubble. Others told me, I don't think so, but it's priced to perfection. So what does that mean when it comes to valuations? It means that earnings season is going to be critical to supporting this rally moving forward. We need to continue to see that growth. We're off to a pretty strong start with the banks, TSMC raising that guidance for the second time this year. That's another sign of optimism that demand is there, that we're going to continue to see the AI trade move forward. But if we see growth that maybe doesn't meet expectations, I think you're setting up for a potential big fall in not only some of these names, but the broader stock market as well. And that's why you have a lot of strategists on the street calling for a short-term correction, a short-term pullback at some point, because when you're trading at record highs and when you're trading within a stock market that's very concentrated, that makes the rally more vulnerable to those pullbacks and some type of volatility. So I expect to see continued, risk moving forward and continued volatility.
Brooke, I forgot to ask, you trying any of these Starbucks protein drinks yet? You down?
I have not tried yet, but it's on my to-do list this weekend. So
all right, yeah, asking the tough questions here at Yahoo Finance. Thanks for holding it down, team. Big thanks to my opening bid roundtable, Cameron Dawson, Ali Canal, and Brooke DePalma. Appreciate it. Coming up, Salesforce's Dreamforce gets a poor grade from one Wall Street analyst, and DocuSign CEO stops by for our Power Player segment. We'll be right back. The analyst notes are trickling in following Salesforce's Investor Day on Wednesday, where it provides some very hopeful guidance. Some on the street are saying that guidance is too hopeful in light of the powerful AI headwinds Salesforce is facing. Here's what Guggenheim had to say after attending Dreamforce. Quote, a lot of the growth expectation hinges on the company's ability to monetize Gen AI and agentic AI, which we continue to be skeptical of, not only for Salesforce, but even for other application vendors. I'll have more to say about my time at Dreamforce and Salesforce shares tomorrow in my Stock of the Day segment. Trust me, you do not want to miss that one. Got a lot to say. All right, software stocks have mostly not played the AI stock boom of 2025. Blame fears over how ChatGPT and other models may impact the long-term business models of software companies. Let's talk more about this with DocuSign CEO Alan Tiggeson, who is here for my Power Player segment. Alan, good to see you. I can't believe I missed you at Dreamforce. I think I was standing next to you at one point. Nonetheless, here we are. Let's start on Dreamforce. What were your takeaways? I mean, thousands of people there. What was your vibe on AI demand?
Well, I think there's a lot of customer interest in what's next. Almost 90,000 attendees, so we're almost back to pre-pandemic levels. I think Salesforce has a pretty compelling roadmap, and of course we presented our roadmap for intelligent agreement management, and I think that's been very well received.
We're living in the world of agents. How are agents flowing onto DocuSign? Are they flowing onto DocuSign?
Yeah, so we announced this spring that we're launching a series of contract agents. To build an agent, you both have to have the data to power the answers and the decisioning, and you have to understand the workflow, basically the steps that people are taking that you're trying to automate. And we understand that better than anyone in the agreement context, and so that positions us very well to deliver compelling agents that save people time and money.
Is voice the next frontier for agents?
I do think voice will be a very important means of input, but a lot of these agents initially are deployed in context where you're using chat, and so that's an easy thing to interpret. But voice is becoming increasingly interchangeable with text, just because the interpretation is so good.
There's been this concern, Alan, that these agents are cool. I mean, they're very helpful. They drive worker productivity. They help a lot of the software companies. I saw Salesforce, how they're using their next iteration of agents to drive more business and drive more business at their key customers. Are folks like you, are your companies like you, are you getting paid for this extra investment in agents? And if not, when does that money really start to flow in?
I think on the agent front, it's still very early, but in terms of the broader AI themes of getting paid for that, I think in our Q2 results, we announced that we're seeing very strong growth from our intelligent agreement management suite, which is AI powered. We've said that's going to be low double digit of our entire book of business by Q4. So it's a very powerful enabler for us, unlocks all the data in the agreements, and customers find that very compelling.
How concerned are you about what OpenAI is doing with ChatGPT and how it's starting to move into other verticals?
OpenAI is a hugely important partner for us. A lot of our AI is built on theirs and other frontier LLM models. I mean, what they showed is it's well known that it was an internal demo. Everyone knows you can put a document in a consumer GPT engine and get a summarization and some answers to some questions about the documents. I think that's table stakes. What we provide is we enable taking your entire agreement library and giving you context about that. So that gives us a huge data advantage because we have already over 100 million private consented agreements that we're running the AI on, which improves the accuracy of the answers meaningfully. We understand the workflows end to end, so that gives us additional context and allows us to deploy agents, as I mentioned. And last, of course, there's the trust and security equation. We're trusted by most large companies, government organizations, nonprofits to handle their agreements. Agreements are sensitive. It's the most important data a company has, and so I think those three factors position us very well to help bring AI to agreements.
The pace that an OpenAI is moving to release new products, update models, whatever it is, how has that changed how you think about your product roadmap over the next year, and even in terms of speed of executing on that roadmap?
Well, it is the fastest pace of technology development that I've experienced in my many decades in tech. And so you do have to be on your toes. We're trying to take full advantage of the incredible investments that OpenAI, Google, Microsoft, Anthropic, and others are doing, as well as the data center deployers and the NVIDIAs of the world. It's an incredible time to be taking advantage of all those investments and building on top of that to enable entirely new workflows and insights for companies. And you have to look out 6 to 12 months because the capabilities are changing so rapidly that if you're just building on what's available today, you're going to miss the next turn.
What's next for DocuSign?
It's really bringing this end-to-end suite for agreements. First, we want to be the system of record for agreements. But I think ultimately we want to be the system of action. We want to help you take action on your agreements, whether they're in process or have been completed. If we do that, I think DocuSign is going to be very well positioned in the long term. You've been around tech for a while, and how concerned are you that it feels, and not even just feels, it looks too euphoric? I mean, so many private companies getting record-setting valuations. I mean, and they're not making any money today. They're not making any money tomorrow. Maybe not making any money 4 or 5 years from now. Like, how concerned are you about the valuation perspectives out there in tech? I have been through a few cycles, recognize pattern, but I just think AI is such a powerful once in a decade or even less trend. It's so profound in terms of how it's transforming literally every business and certainly every tech business. And so I'm focused on that. It's not like just because there was a bubble of the internet that the internet wasn't important, or the telco build out, or mobile. And I think this one is at least as big. And so I'm focused on that, and the short-term volatility and valuations are less concerning. Before I let you go on, at Dreamforce, I sat down with Starbucks CEO Brian Niccol, and I asked him this question, what his one-word outlook for the economy in 2026 is. I'll put that same question to you. How do you see the economy unfolding? We're holding our outlook steady. We project what we see, and that hasn't changed. All right, we will leave it there. Alan, I can't believe I missed you at Dreamforce. Good to see you as always. Have a great weekend, and we'll talk to you soon. Appreciate it. Thank you so much, Brian. All right, coming up, Julie Hyman has you covered from Market Catalyst. Don't go anywhere. Lots happening on that show with Julie.